Hey guys, welcome back to Compare Return, Fixed Income, the complete introduction. How you can take, as an expat, a lump sum of money and turn it into an income generating stream for retirement and how to avoid being scammed. We're going to go over 4 sectors. We're going to look at bonds, we're going to look at structured notes, we're going to look at investment properties, and we're also going to look at loan notes. So the reason why I'm doing this video today is because a couple weeks ago, I was actually approached to conduct some research into the sector. Complex derivatives is something that I've worked in for many years now. I've got a real passion for it. And I really thought, hey, if I'm going to be doing 15, 16 hours worth of research, screens on screens on screens of bonds and all these different product providers, well, why don't I just give you guys a little bit of a background on it as well? So living offshore can give you some fantastic opportunities for investing. You've got the best of both worlds. So you've got access to all the traditional markets you'd have access to in your home country, but also everyone else's home country. So UK, Australia, US, you name it. But you also have access to the offshore markets, and there can be some fantastic investments in those as well. So fixed income, and why today, why now? Obviously, it's because in the current interest rate climate, if you go out and loan your money to the government, you might be lucky to get 1%, 1.5%. If you go to a bank, same deal, on your US, on your Euros negative interest rates, you might get 0.5%, 1% return, whereas traditionally, you might have got 5 or 6% return, whereas today it's not out there. However, in the next following things we're going to be talking about, some of these do return you some fantastic returns, 4% all the way up to 10, 11, 12% return. So you can get a decent basket if you know what you're looking for. And I'm going to show you today how. Fixed income, typically at the very basic, is loaning money. So whenever you're lending money to someone, you need to be careful. And in this video, I'm going to show you what to look for. With these structures, the devil really is in the details. As always, this isn't meant to be taken as financial advice. This is just my opinion. Please seek the advice of a professional or educate yourself. I'd like to introduce you to today's investor, which is Trevor. Hey Trev, how you going, mate?
Hey, g'day mate. Yeah, cheers for having me on your telly show. I'm going to be able to brag to the boys down the pub that I'm on the telly, mate. Yeah, so nice to meet you.
Okay, fantastic. Whereabouts are you coming to us from, Trevor?
I'm out in rural Queensland. So yeah, out in rural Queensland.
Okay, so my first question for you today is, are there any parts of Queensland that aren't rural?
Not really, eh? Not really.
Okay.
Anyway, I'll tell you a bit about myself. So I've done all right, done all right for myself. I've been out in the rigs for probably 30 years now, 35 years. So I stepped up as a junior and now I'm sort of running the show. But, mate, I'm getting a bit long in the tooth. So figured it's time for me to pull up, pack up stumps and sort of head off home. The kids are all grown up, the missus, she's happy. So yeah, time for me to retire.
Okay.
Got a couple of mil, not doing too bad for myself, but I want to put about 500,000 of that into some fixed income so I can get myself, about a $35,000 a year return. So that's kind of what I'm looking for, 6%, 7%, something around there is kind of what I'm looking for, mate. If you can do that for me, I'll be a happy camper.
Okay, well, it sounds like you've got a pretty good understanding of what you're looking for, mate. So let's get stuck into the video for today, and I hope this helps you out.
Okay, mate, cheers for that. I look forward to it. Yeah, let me know what you come up with, eh? Yeah, cheers.
Okay, so for Trevor, using the 5-bucket approach, which I've also gone to in a link in the description below. It's a whole video on how to diversify yourself correctly for retirement. He can really ensure that this structure is going to give him a decent foundation to work from moving forward, and most importantly, give him a dollar income that he knows is going to be income that he can then spend for retirement. Okay, so category 1, guys, is corporate bonds. So at the very basics, a corporate bond is a loan to a company for a predetermined period. In return, that company agrees to pay you an income or interest, which is typically twice a year. It might also be annually, it might also be quarterly, it could also even be monthly, until that investment or the bond matures. Let's use a typical fixed rate bond as an example. So say if you invest $1,000 for a 10-year bond that's going to be paying you 3% per annum, they're going to be paying you $30 a year. and they're going to give you back your original $1,000 investment in a decade's time. So when you're buying bonds, there's typically three ways to buy them. First way is a new issue. So what a new issue is where you go into the market and say, for example, Xerox is looking to generate $100 million of revenue for the company, and they do it in form of a bond. So they'll put that out to market. It's not yet subscribed, or they're taking subscribers on. That's the first way. The second way is the secondary market. So what that means is, say, for example, if a bond was over 30 years, someone gets 15 years into it and they want to sell. So you can actually go out onto the secondary market for approaching people like brokers that then can able to settle you with that bond. The thing to keep in mind about that, guys, is that these will have a net asset value. They'll trade at either a premium or a discount. So say, for example, if 15 years ago, Microsoft was paying you 8% per annum because interest rates were higher, then today that will typically trade at a premium. So what that means is, to get into it, it might be now valued at 130. What I'm trying to tell you here, guys, is there's no magic secret unlockable door in the bond market that's going to get you fantastic returns that your financial advisor didn't tell you about. Don't jump onto Google and Google bonds and then tell your financial advisor that you've seen this for 10% or 8% or 7%. They don't know what they're doing, because typically those are yield adjusted. So you've got to keep that in mind. And the third one is bond funds. So you might want to get on board with an exchange traded fund or a fund that buys ladders. So say, for example, if that bond has $1 million in it, then it might be broken down into a series of different corporate bonds. HYG ETF is a classic example of this. So that could be a good way for those that aren't high net worth investors to get a little bit of exposure to the bond market. ETFs are traded on what they call a 30-day SEC yield, which dictates how much you're going to get back. And that's bonds, guys. So why people typically invest in a bond, why invest in Microsoft, Dell, HP, take your pick, Xerox, Huawei, Apple, any major company, is because the returns are typically more stable than buying the equity. So say, for example, if Apple's stock price crashes by 30%, unless there's insolvency, so unless Apple goes bankrupt, the return of your bond's going to be rock solid. So that means that you're always going to be getting that money coming in. So people typically pick bonds over equities because they're genuinely looking for that fixed, stable income for retirement. Okay, the second one we're going to be talking about is structured notes. Now, I could probably do a whole video on structured notes just on its own. So if you'd like to see that, send me an email, leave in the comments section. Tell me a little bit more. So at the most basic layman's terms, a structured note is a debt obligation that also contains an embedded derivative component that adjusts the security's risk-return profile. The return performance of a structured note will track both the underlying debt obligation and the derivative embedded within it. Sound easy? Well, they're not. Structured notes are complex derivative investments, typically for sophisticated investors. To give you a proper layman's introduction to structured notes, I was being a little bit cheeky before, is that the cost or the price or the value of my headphone case is derived by how much battery is left in my phone. So if that's still sounding a little bit complex, once again, they are. But what that means is the headphone case might be issued by Goldman Sachs, and it's going to be paying you 5% per annum, as long as the battery in my phone doesn't dip below 80%, which is the S&P 500. So that's the product, and the underlying, or what it's investing in, might be the S&P 500, it could be the FTSE, it could be any number of things. It could even be individual stocks and shares. The great thing about structured notes is they can be created in a huge variety of ways that can provide you a fixed income return that isn't typically able to be found anywhere else. Structured notes may offer increased upside potential, so that might be a participation rate. So say, for example, if a note's giving you 150% participation in the S&P 500, what that means is if the S&P 500 goes up by 10% in a year, the note might return you an income of 15%. They might also offer you minimum downside risk, so they might have a market barrier. So what that means is that a note will still return you 8% per annum as long as the FTSE 100 doesn't dip below 30% of its current value. So that's a 70% barrier. So they might also have that as well. And they can also be good at sort of leveling out overall market volatility over a long period of time, say 4, 5, 6, 7 years period. Some structured notes can return as high as 15 or 16% per annum, even from companies such as Goldman Sachs or Barclays Bank or JP Morgan. So there are some fantastic offerings out there in this sector, but you really have to look at the following. The first one is issuer risk. Who's issuing this structured note? So say, for example, if it's Dodgy Bob's bank down the road, well, the guarantee from them might not be worth the paper it's written on. So make sure you're only taking out notes that are issued by a trustworthy credit or good credit rating institution, or alternatively, make sure that the returns warrant that extra risk you're taking on board. There's also a ton of variety of them, guys. There's auto-callable notes that'll pay you out once, so that might be compounding. You know, it might be a 10% per annum, which in year 1 it's 10, in year 2 it's 20, in year 3 it's 30. So it's only going to pay you out once, but it's going to pay you out big return. They might be quarterly income, which, as the name suggests, returns you an income every quarter. They have market barriers built into them. They've got memory features. There's a whole heap of things going on in these and a lot of bells and whistles. With them, they are priced on the secondary market. So if you do take out one of these notes, one of the things you might notice is that it might trade at a discount, or in other words, it might show as a loss on your portfolio even. Don't worry though, all that means is that you can sell out of these notes, which is a good thing. You know, there's a secondary market, so if you do want to sell them, you can. Now, the secondary market pricing is considered like this. You've got an agreement between me and you. The agreement is that as long as markets don't dip by more than 30% per annum, that's the S&P 500, the FTSE, and say Euro stocks or the Australian Stock Exchange, as long as the markets don't dip by more than 30%, I'm going to pay you a 10% per annum income. So that's the agreement between you and me. That's over a 5-year period. So we've got plenty of time. So say, for example, if the markets drop by 11%, the note might show that you've actually lost 11%. But you and me both know that the agreement is as long as it doesn't drop by, say, for example, 20%, you're still going to get that income. So that's how they're priced on the secondary market. There's also issuer pricing, you know, timeline to maturity, how close it is to an auto-callable event, and a heap of other things. Things to look out for with structured notes is too many indexes that are not correlated. You know, if it's got, say, 3 indexes, it's got the Indian index, it's got the American index, and it's got the Spanish index. Those are 3 markets which might work inversely. So if you need all 3 of those markets to be hitting their trigger, say if it's a 10% barrier, you might have America's up 20% and Spain's up 15%, but India's down 20%. So you continually miss out on your coupons. So trying to keep all the indexes together, or at least close to being together, is a good thing to look out for. One thing I will note about structured notes is you want to be careful with the correlation. So for me personally, I tend to stick away from emerging markets. Okay, now the third one we're going to go over is investment properties. Like always, look at the comments section or the description in this video below. You're going to find that I've also done a video on the 3 biggest mistakes expats make when buying investment properties. So that's typically being too emotional, you know, not using leveraging, which if you're transitioning into retirement, you might not want to be looking at leveraging or taking out a mortgage for the property. You might want to own it outright. And the third thing is not picking the right company to work with. In my opinion, investment properties are fantastic and everyone should have a little bit of investment properties in their portfolio. That's my opinion, guys, but they can be great. You know, look for rental yields of sort of 4 to 6% per annum. The other good thing about investment properties is you get the capital growth. So when it comes time to sell the property, say for example, if that property has grown from $100,000 to $170,000, you've also got 70% worth of capital appreciation you can work into your average yield over however long you've had the property for. So that's all I'm going to talk about in properties, guys, but they are a fantastic one. If you want to know more, watch the video in the description. And the fourth and final one we're going to talk about, guys, is loan notes. So basically, a loan note is just a really fancy IOU where you lend money to one party in the agreement that they're going to pay you that money back, typically with interest. That's why we do these. These can come in many different shapes and sizes, guys. It could be, it could be money being lent to a gold mining company for exploration. So they want to, for example, have $5 million to go out for gold mining exploration. And then obviously if they're thinking that, we're going to be diversified enough that we're going to hit some gold and then we're going to make 400% return on that gold mine, and that's going to allow us to pay back the investors. Or it could be in, complex structured loaning where they're taking out loans or micro loans, which is obviously a little bit more untangible or risky. They might be in litigation cases, it might be in construction, it could be in any number of things. So let me give you an example of one of these. It might be that you're lending money to a construction company. That construction company then goes out and completes projects. It might be building petrol stations, it might be building roadside retail, Starbucks, KFCs, all those kind of things. Now, that construction company knows that when they've completed a project, the return on their investment might be 300%. And for that, they're happy to give you a 10% per annum, and that's over a 2-year period. So that means that you're loaning money to this company over a 2-year period with the expectation that they're going to pay you back the income and your original capital investment. So obviously the things to look for this might be, how many properties have they completed in the past? How many properties have they currently got under construction? How experienced is the board of directors? What's their projection like? How many projects are they looking to do? Are the projects able to be seen on Google Maps and things like that? What's their public presence? So that's just one example of a loan note. Now, some of the things to look for in loan notes are the following. Diversification. Obviously, you don't want to be putting all your eggs into one basket if you're looking at this sector. The term, how long is it for? Is it over 1 year, 2 years, 3 years, 5 years? The other thing to look for in the due diligence process is the security. Is it asset backed? Are you investing in actual physical assets, and do you contractually own those assets? If it's something like insurance repackaging or micro lending, in that case, you don't really. You own the capital of the company. So you want to be making sure the company's books look really good. Also, is there any insurance? So, is this company insured? And do you get access to that insurance payout should the company go insolvent? These are all things you want to be looking at for loan notes. Also, if it offers the G word, a guarantee, who's offering that guarantee? If it's something like Barclays Bank and there's 100% backstop at Barclays, well, that might be fairly stable. But one of the ones that I found out in my research had only been around for 13 months, was registered. So I'm looking at the company's registration on the UK Companies House. They'd only been registered 13 months ago. It had 3 members registered. One of them had already resigned. The 2 remaining people, one of them was only 34 years old. The other person I couldn't find any public information about. The actual investment structure was in something which wasn't tangible, so there was no physical asset backing. So for me, immediately, straight in the bin. Okay, guys, so that's loan notes. These can be fantastic. You can have returns of 10, 12, 15% in the market for these. So you can get some really, really good fixed income. But the thing to make sure is diversification. So for Trevor, welcome back, Trev. Mate, did you watch the whole video? How did you find it? Okay, so it appears that we've lost Trevor. My best guess would be that he's probably already down the pub having a couple of beers. Let's go over Trevor's situation. So Trevor wanted to invest $500,000, if we remember. Now, he might want to invest in something like, for example, 14 different investments over the 4 categories we've talked about: bonds, structured notes, loan notes, and also investment properties. Obviously, investment properties is going to be difficult to shoehorn into that, but let me just give you this as an example. If you took $500,000, $500,000, invested in 14 different investments, that would be $35,000 in each investment. Now, if he's got $2 million worth of assets, that would represent 1.7% of his net worth. Although nobody wants to lose $35,000, if you can stomach that and it only represents 1.7% of your portfolio, then hey, your exposure isn't that big as a percentage. That's why you need to be very high net worth with these investments, because if $35,000 represented 35% of your retirement pot, well, you're going to be wiped out. So if you've got tons of different diversified investments in a deep portfolio, good job. If in the past year you've earned more than 150,000 US dollars, or if you've got net assets of over $350,000 that don't include your primary abode, the house you live in, doesn't include your pension or any contract obligations or any insurances you've got, Why don't you and me have a chat about it? You'll notice that we've also given you a Calendly link where you can book in and have a chat to me. I love talking about fixed income investing. It's something that I've got a real passion for, if you can't notice. If you don't want to book in and have a chat, why don't you tell me about it, guys? Why don't you send me an email? Tell me what you liked about this. Tell me what you didn't like. You are my eyes and ears. And that's been fixed income investing, how you can generate an income for retirement from a cash pot. Hope you enjoyed the video today, guys. As always, like and subscribe and all that sort of stuff. And we'll see you guys next week.